Enable. Tri-Legal presents Mint India Investment Summit and Awards. Knowledge partner, KPMG.
The Mint India Investment Summit is an annual gathering of India-focused private equity investors. On day 2 of the event, Anuj Ranjan of Brookfield Asset Management delivered a keynote speech sharing his outlook on the Indian economy.
So the one thing that I think is really interesting, and these are just a few stats that I think are really useful to take home. India is actually 3 economies if you break it down. The first 100 million people are basically exactly Mexico. From a GDP per capita perspective, from how they spend, from a population size, that first 100 million people is basically Mexico. The next 100 million people is basically the Philippines. And again, from a GDP per capita perspective, a lot lower. From their spending habits and what they do, pretty much exactly the same. The last 1.2 billion people is sub-Saharan Africa. Now, the funny thing is these stats were exactly the same in terms of percentages 10 years ago, and they were exactly the same 20 years ago. The real opportunity in India has always been bringing India 2 and India 3, that Philippines and Mexico and sub-Saharan Africa, into the formal economy. And that is the opportunity, but it's something that has structurally never happened in India, and it's what has held us back a little bit from markets like China, which had the same GDP 20 years ago to India. We genuinely think this is all about to change in the next 10 years. All the pieces have come together. They're measures by the government and the RBI, and the private sector has created a platform for growth. So I'm going to break it down to 3 things, what I call the geo effect, the Aadhaar card, and the RBI's successful inflation targeting that's made a huge difference. Now that leads to how I think investment themes will be over the next 10 years. Again, I think there's a huge positive backdrop for India. We as Brookfield, and I'm sure most foreign investors, are excited about this market for all those reasons I said earlier. But this credit issue is causing a situation where I see the types of transactions happening moving towards buyouts of entire businesses. Private equity being minority growth investing will continue, but buyouts of businesses you've already seen move up, initially because the investors wanted it that way, but now it will happen out of necessity, whether it's businesses going through NCLT and requiring a new sponsor to step in, or whether it's companies just having to hive off entire businesses. We at Brookfield have done this with our roads, our office, the gas pipeline, other transactions that we're doing. We've actually bought entire businesses, and I suspect I've seen others do the same. And this will continue. I think it will get very much more prolific. We also think that driving operational efficiencies, if you're buying out a business, you have to operate it. And those who have an operating mindset and are able to actually run the business will be the ones that can actually take advantage of this situation and do the most with these portfolio companies. And lastly, I'd say creating platforms for scale. You've seen this successfully done already by a few foreign investors. We've done it in both office buildings and roads, for example. But buying out businesses will then allow others to consolidate the industry around that business and create a larger platform with scale that I think is very attractive, and we're going to see a lot more of in the space. So that's my views on the next 10 years in India. None of us can predict it completely, but we're very excited. And the challenges, frankly, of the NBFC crisis truly bring great opportunities. So we're here to stay, and we're excited to do a lot more. Thank you.
First of all, Anuj, so good to have you, finally. And thank you for that. I think it was a great overview of how Brookfield sees about 10 years of investing in India. But tell me one thing, where does India really figure in your pecking order? Is it the brightest spot? Is it at number 2 or number 3? For a large investor like yours, one would want to understand your mindset for India.
Sure, it's a good question. India, so the nice thing is, to start with, we raise global funds. And we believe investing out of global funds because then we're not necessarily compelled to do investments in any jurisdiction. If Brazil's a great place to invest, we put capital there, as we did in our last series of funds. If Europe's a great place to invest, we can put capital there. India, I think, has been a consistently good place to invest. To put it in perspective, our recent fundraises across our 3 flagship funds, real estate, infrastructure, and private equity, has totaled $50 billion US dollars this year. And India today is our number one spot outside of our core markets. So when I say US, Europe, outside of those markets, India is, from an emerging markets perspective, by far our favorite market today. And therefore, of $50 billion in capital, I see no reason why, if we have the right opportunities, $10 billion could come here. On the 7 that we've already put in, we could easily reach $17, $20 billion of AUM in the country. But it will really just depend on the opportunities. That number could be 0, it could be much bigger.
Trilegal presents Mint India Investment Summit and Awards. Knowledge partner, KPMG.
In the third track of the summit, global and Indian investors shared their views on infrastructure, the opportunity in crisis.
I think the opportunity right now, whether it's stress or not, is the fact that there's, in India right now, both the opportunity to buy assets as well as the opportunity to build assets. Just to give you a sense, about $1 trillion of infrastructure assets were built over the last decade. About 300 billion of that was built in the private sector. A lot of the stress that we talk about is actually in the thermal power sector. If you were to, and it's, you also can't paint infrastructure with the same brush, because if you look at different sectors, the situation in those sectors is very different. And if you leave aside the thermal sector, some of the cleanup on the roads, in the road sector has already happened. But I think what you see now is a lot of high quality capital coming into the country and going into these assets through platforms or well-managed, well-capitalized entities with a much more longer-term mindset.
The next wave of investments will be in the stressed asset space, not good assets but stressed promoters. And I think the Insolvency Bankruptcy Act, the NCLT, and the direction from RBI and the government to fix these assets is a step in the right direction. It will create huge opportunities for funds like us to go out and collect some of these stressed assets and fix it.
I think in 25 years we won't have thermal power plants. So anyone investing in thermal, I would think 10 times, not twice, about putting money in that space. And the reason I'm saying that is possibly, if you think about from an India perspective, I call it the holy trinity: energy demand, energy supply, and what it does to climate as a whole, and the whole commercialization of climate. Energy demand, India is possibly one of the fastest growing energy countries in the world. The second is on the supply side. Supply has historically been fossil fuel based supply. India today, if you think about it, needs other forms of energy, because not only is it good for the climate, but also it's the largest import component today in India's fiscal balance sheet. But I do think the dependence on that has to keep coming down if we as a country have to essentially become self-reliant. And solar is the best way, wind to a certain extent, but solar more so, the way to basically try and reduce that dependence.
Yeah, so see, the fact that some of the leading infrastructure investors have become half lawyers themselves, that should not be the case. I think at a more general level, if infrastructure investors are freer to think about how they deploy their capital, rather than the variety of legal risks or concession risks, I think would be an ideal situation.
The investors' minds were probed on whether the real estate sector is finally out of the woods.
It's a two-prong, right? First is the investor preference, and there are a set of investors that prefer residential. There are a set of investors, like what we have a number of them on this panel, that prefer yield as part of their investment strategy. But there are a set of investors and NBFCs to a certain extent who prefer residential as an investment. The second point is more of a demand and supply. I think we're just in a cycle where residential has kind of run its course. It's at a time where there is enough supply and not demand. But on the office side, we still have the GDP in excess of 6.5% to 7%, still kind of doing well. which means the demand for commercial office will continue to increase as we look forward. And that is why I think the preference for capital to be continuing to be deployed in office.
Markets in general have become mature. If I contrast it to what the capital flows were before, I think we came into existence, to the fact that what exists now, very clearly one, maturity of cash flow in terms of investors now looking to invest long term with clarity on risk that they are kind of undertaking. Because earlier, if you see the era of, let's say, 2004 to 2012, very clearly investors said India, high returns, very clearly did not see the commensurate risk that they were undertaking. And you obviously saw the aftermath of that period. The way we've seen the last 9 to 10 years is very clearly investors are a lot more clearer about what they want to invest in. Are they chasing IRRs or are they chasing multiples? I think what Chintan alluded to, that, do I want self-liquidating assets or do I want long-term assets which very clearly mature over time and provide longer-term returns? Maybe they are muted, but very clearly multiples are there. And I think I almost see it as a foil for the growth that India would see.
Today, India is amongst the 5th or the 6th largest economies in the world. But in terms of quality, high quality real estate stock, that number is significantly further behind. And as that gap bridges, there will be significant amount of value creation across all different asset classes. But that doesn't mean that growth always translates into returns. And how we have approached execution of that strategy into returns is to essentially partner with top-tier, highly qualified partners. I have Rajesh from Shapoorji here on the stage. We have similar relationships with Endospace in Phoenix, who are very specialized in industrial and retail in that sense. And essentially structure partners which are able to respond to the market from a longer-term perspective. And that's how we have generated the returns in that sense.
Tri-Legal presents Mint India Investment Summit and Awards. Knowledge partner, KPMG.
In the final track of the summit, a spotlight was put on special situations, downside protection versus alpha.
There was a lot more excitement in the marketplace in terms of, the IBC cases were just getting resolved. The first dozen were at the fag end of their resolution, and I believe the excitement levels are much higher. A lot more realism has now sort of come in, where things haven't resolved as fast as everybody hoped they were. It's still early days, so people are willing to give it latitude to say, we shouldn't judge the IBC based on this last 12-month period. So one is a little bit of a dose of realism has entered in the last 12 months. But the fact that 29A is here to stay has indeed played out how promoters have approached, the era post IBC. So that hasn't changed. It has sunk in, and hence pre-IBC, deal making has increased. So IBC may be a little softer than it was a year back. Pre-IBC, a little more active than it was a year back.
So from my perspective, see, most of what we read in IBC and, some of the frustration that builds in is actually related more to the larger cases. Larger cases, bigger borrower, more resources, they have the wherewithal to, continuously keep elongating the process, etc. But as a thumb rule, I can tell you, if for every one case that goes into IBC, there are 2 that are getting resolved. In fact, I was just speaking to someone, one of your colleagues, some time back. Look at what is happening to one of the largest aircraft carriers. I would say that it's a very positive development. Almost all stakeholders there are aligned that it should not go into IBC, right? So there is a lot of work happening to try and resolve it outside of IBC. So yes, I mean, let's be positive here. There is a lot of work that is already happening, and I definitely see that one of the most salutary developments as part of the framework is that now very clearly it's sunk in both for the owners as well as the lenders that there is a certain boundary condition within which you need to operate. If you don't, there is a real risk of you losing the company. And when there is a real risk of losing the company, it's remarkable how capital starts flowing in from all sides of the capital.
So obviously, because it's distress, our focus is more on the downside protection. But the way we look at it is, once we fix the EV, we work across the capital stack and ensure that a fair amount of our capital actually goes in where, because there's underlying security of the fixed assets and the cash flows, and quite often we are the single sole creator across the capital on the debt side. A significant part of the return comes and the capital comes back from there. And then, of course, the alpha is a combination of a warrant or equity which you exercise as the company turnaround goes through. So that's the way. It's really largely debt capital protected, right, with an upside on a case-to-case basis.
The summit concluded with the investment community's best minds sharing their views on the Insolvency and Bankruptcy Code, the bumpy road ahead.
See, I have EPC companies with me. I have no solution for that, to be honest. And I have asked this to so many experts, like, the Big Four, Big Six, and people who are, spend lifetime doing engaged in, and working in EPC companies. There is no solution if you take it to the IBC. See, there are trading companies, big trading companies. Suddenly there is nothing there. Once you go to the IBC, there is nothing there. Maybe a little collateral, that's all they have at the end of the day. Shipping, if somebody has shipping, I knew so many shippers in my earlier assignment, they say only 2 days, they're happy days. The day the ship is bought and the day the ship is sold. Otherwise, it's like misery. Now it seems the misery has come to the banks, whoever has dabbled in shipping. I'm looking at in shipping cases where I'll be out of pocket. Because there are cases against the bank by the workmen, by the sailors. The shipping rules are very sort of rigid. Whatever you have, whatever you get, the first penny goes to the workmen, the sailors. Then to the port. After anything is left, only you get it back. And the way the Baltic Index is moving downwards, southwards, I'm sure that we'll end up just paying the RP's fees and the process advisors' fees and the court fees. And maybe end up paying something more to the sailors also. That's the kind of scenario we're looking for.
I think one of the things underneath it runs as a theme across all situations, pre and post NCLT filings. Pre-NCLT, it's easier to get the information if you're working cooperatively with a promoter and therefore expect to be able to help rescue a business. So I think the rescue capital business is looking more and more interesting. Within NCLT, now you're starting to find management teams that are coming together and will help you take on and kind of run with an asset. The tricky piece again there is the paucity of information. I think the 6-month timeline with the amount of time taken up front to kind of put stuff together and then working backwards to start with the 6-month deadline, then the 9-month deadline, leaves this, the entry of capital, which you could argue is an important part of the equation. 15 days to kind of look at something and say, yeah, no. The usual answer is no.
I think IBC, that process was needed, for sure. I mean, it's before that, all the solutions were very weak and didn't really produce a lot of results, which got India into the situation it was. And it has brought a cultural change. I can see it in the way that shareholders relate to lenders and the banks and how they're behaving, and I think it's provided some discipline. But it's just one form of a restructuring solution. There are a lot of pre-tribunal one-on-one discussions going on, smart proposals looking at turnaround solutions, and savvy investors looking to pick up assets without going through that process. But I think there's a little bit of a missing link there from the lender's point of view. I think it's a problem mainly with the banks. They, as the lenders, have competing interests. So it's usually not just one bank that's the largest lender. So that's problem number one. Problem number two, they're racing against time. And at the end of it, there's a lot of liquidations or whatever. The recovery chances are relatively low.
I think the IBC requires both the options. Maximization of value of the company or otherwise faster liquidation of the assets. I think in judiciary I find that view that somehow liquidation should be avoided at any cost. And it's a wrong approach The assets which are not giving us money, the capital is not efficiently deployed, let it be liquidated. I just read one case judgment yesterday, by the way, just interesting judgment. The liquidator has said the asset value is 9 lakh. The claim was 4,500 crores. And he has just said this 9 lakh is not sufficient even to take care of my fees. I am just liquidating, and I request the NCLT to, dissolve the company.
TriLegal presents Mint India Investment Summit and Awards. Knowledge partner, KPMG. Focus. Ideate. Innovate. Enable.